Hi everyone, I'm Lee Pacchia and you are watching The Business of Law, the only web TV show focusing on the challenges and opportunities facing the legal profession. We're doing a deep dive on mergers and acquisitions today. I'm happy to say we have the one and only Frank Aquila joining us. He's a partner at Sullivan Cromwell. Thanks for joining us. Welcome.
Thanks, Lee. Always good to see you.
Good to see you. So we're almost halfway through 2014, and the numbers say that M&A activity is back to 2007 levels. Are we seeing a modest boomlet, or is deal-making back?
Deal-making is back. I think it's back in terms of the numbers. We're seeing the big deals. We're seeing the big deals sort of week in and week out. We're seeing unsolicited deals. We're seeing cross-border deals. We're seeing deals in multiple sectors. So all the indications of an M&A boom. I think what we're not seeing is people rushing into deals. Mm-hmm. We're seeing still a certain amount of caution born out of the last 5 or 6 years, which is a good thing. I think what we're also seeing, which we did not see in prior boom periods, is acquirers' stock going up. So you're used to the target company, the company that's getting bought, their stock going up on announcement. But in not all deals, but in most deals, the buyer's stock is going up too, which means that the market is looking at these transactions by and large and saying, this makes strategic sense, it makes financial sense, it's going to be accretive. So that I think is a good thing, and it means that people are being disciplined.
Have you seen that phenomenon before in your career? I mean, to me it jumps out as kind of an unusual data point that acquirer stock is going up after they do a deal. Is that unheard of?
It's not totally unheard of. I've seen it in particular deals from time to time, but you haven't seen this before consistently in deal after deal, and that's what we're seeing now. And again, I think it's a good sign because it means people, while they're taking longer to get their deals done, they're only doing the deals that make sense from both the buyer and the seller standpoint.
I wanted to talk to you about the notion of financing. This time around, it appears a little bit different. According to the FT, much fewer deals are all cash compared to what they were in 2007, and more relying on stock. And we're also seeing more cash and stock deals. Any idea why that is?
Well, I think every deal is different. I think there are certain reasons why, particularly in some of the cross-border deals, why they need to have a stock component. Often that's for tax reasons, and again, that's a particular situation. Sometimes it's because the company being acquired believes that there's a lot of upside in the combined company. Again, that's part of the rationale for the transaction. Both parties believe it's a good fit. There's a lot of synergies, a lot to come from the combined company. But I think more than that, companies they don't want to get back to where they were in 2006 and 2007 and early 2008. They don't want to get too highly levered. And so using some equity or selling some equity after the fact allows them to have a fairly rational balance sheet. Having said that, many strategic buyers have plenty of cash on the sidelines to do deals, and they also have access to borrowing at record low rates.
One of the great tension points out there is between CEO confidence and uncertainty over the macro picture. When you speak to your clients, where are their heads at these days? Are they generally seeing us as being in a world where the macroeconomy is on the mend?
Well, I think one of the things we've seen for a couple of years is that most of the factors you need for a strong deal-making environment for a lot of M&A have been in place. The thing that was not in place is business confidence. I started to see the change in boardrooms towards the end of last year, where the concerns raised by both directors and management about business confidence didn't go away entirely. They never go away, but really dissipated. I think right now what we're seeing is a view that the economy has gotten much, much better. It continues to grow and expand. It may not get that much better, but it's fairly solid. Certainly the U.S. is in very good shape. Could we do with a much lower unemployment rate? Absolutely. Could we do with a little bit better growth rate? Yes, but it's a strong, solid economy, and I think most people, having spent the last 6 years cutting costs, now are looking for growth, and the way to get growth is going to be through acquisition at this point.
You said before that the deals that are getting done today aren't closing quite as quickly as they used to. Any sense as to why that is?
Well, it's not so much the closing, it's really more, the negotiation period, the investigation period. And that's because people are taking much longer to do their due diligence, much longer even to approach the other side about the possibility of doing deals. And again, generals fight the last battle, and you know what the problems were with deals that were done in the 70s, 80s, 90s, and pre-2008 period. So people are being much more cautious. They're trying to think about all of the potential risks. Let's face it, M&A is now become really professionalized. There are people who, like myself, have focused on acquisitions for 30 plus years now, and we know what to look for, and that means it's going to be a longer process, assuming that the client is prepared to go forward on that basis, and I think most clients are today.
Right. That longer timeline to get a deal done or negotiate, how does that change your day-to-day workflow?
It probably means that you work fairly hard all the time, as opposed to...
You're getting less sleep now than you were 2 years
no,
ago?
But before you would have sort of, these 72, 96-hour periods in a row where there was a mad dash. You still have a period at the end of every major transaction where you're not going to get a lot of sleep, but now it's more work on the front end, and I think we're seeing deals announced certainly on Monday morning, the typical merger Monday, but we're seeing deals announced on Friday or Wednesday, and that's because people are not prepared. Boards are not prepared simply to sign off on deals on Sunday evening. They're very prepared to say to the bankers and the lawyers and to management, we're not comfortable on this issue. Go back, take 48 hours. And I think that's a good thing overall.
No, caution is certainly a good thing. What's your view for the second half of 2014? What sectors and regions do you see getting hot that not necessarily have gotten hot already?
Well, I think, by and large, we're going to see what we've seen in the first half. I think it's going to be a broad mix of sectors. We haven't seen a lot yet, although we're starting to see a bit in consumer and retail. I think we're going to see a pickup in consumer and retail M&A. But I think healthcare is going to continue to be strong. Tech is going to continue to be strong. Those are areas I think we'll see a lot of activity. But really, in a true M&A boom, you see it across the board, and I think that's what we're going to see. In terms of regions, U.S. domestic deals will continue to be the focus, but we're going to see deals in Europe, we're going to see deals in Asia, we're going to see deals in Latin America, and we're going to see a lot of cross-border deals. Certainly we've seen more cross-border this year than last year and the year before combined.
A lot of concern out there in corporate America as to what the Federal Reserve is going to do with rates next year. As I said, they're probably going to go up. Is there a race underway with that in mind to get deals done and out of the way now?
I don't think that's a factor at all. I think what we're seeing today is pent-up demand. Yes, rates are eventually going to go up. You can't repeal the business cycle, no matter how much the Fed has tried with quantitative easing and otherwise. But the fact of the matter is that when rates start to go up, they're going to go up, in tiny increments, and certainly not. They're not going to go up, that quickly. And I don't think that's going to affect the rationale, because if rates are going up, it's because growth is increasing. And if growth's increasing, then you can afford to spend more. And if the financing costs you a little bit more, it all works out.
Frank, always like to close out interviews with you asking about what negative catalysts for killing the growth are out there on the horizon. What keeps you up at night?
Clearly, geopolitical events are always a concern. I think we have to be concerned about, Russia and Crimea, what's going on in Crimea, and what's going on in the Middle East if that ever becomes a shooting war. A terrorist event is always of concern. I think the concerns about China melting down are probably minimal at this point. To the extent that there's a downturn there, that's probably already factored in. I think the elections in India have shown that that's going to have a pro-business government. So I think there are always risks, but it would have to be pretty catastrophic at this point to really turn things around.
Frank, always a pleasure.
Great seeing you.
Thanks for
Take
stopping
care.
by. If you'd like to see more of the stuff we're working on, be sure to go check us out on YouTube, and you can always follow us on Twitter. I'm Lee Pacchia. Thanks for watching, and see you next week.